My next guest is one of the most brilliant investment managers in the business. I want to bring in now the co-head of Liontrust Global Innovation Team, Clare Pleydell-Bouverie. And Clare, I was reading your approach to the market, and it was interesting to me when I saw it, not buy and hold, because it feels like most funds or these trusts or whatever it is are all buy and hold, but you're trying to take advantage of the volatility in the market as well.
Precisely, Charles, which means we're very busy at the moment. I don't think any of us
I'm really surprised they let you out the office today. That's all I'm saying.
But I mean, the reason we're not buy and hold is twofold. First of all, the pace of innovation that we're seeing, particularly in the technology sector, but really across all sectors, warrants a more active approach, but also the volatility in the market. So during these big drawdowns, such as we've seen over the last couple of days, that is when we're very, very active.
One of the things I think that's exacerbating the volatility is this question over who survives, who doesn't, and what's a moat. You put a piece, what constitutes a moat? Can we talk about that for a moment? Because maybe if you have the moat, maybe you don't have to trade it as much.
Sure. I mean, this is possibly the most important question that we think investors should be asking right now, because when we go through platform technology transitions, it's rarely just because of the underlying technology that they're disruptive. It's because it entails business model change. And what we're seeing right now is that moats are becoming increasingly physical. So we're moving really from bits to atoms. And that manifests itself in three primary form factors that we're focused on. First is scaled manufacturing. You think of TSMC, GE Vernova, Tesla. Right. Very hard to replicate that. The second is distribution networks. An AI agent might be able to place an order, but it still needs the logistics networks such as Mercado Libre or an Instacart in the US for grocery. And the third is very hard to replicate software and system integration. NVIDIA, Broadcom are the poster children here. And although it's early, what we believe is that hardware is actually going to be the software of this new cycle. This is where we're seeing the greatest top-line acceleration, but also, most importantly, the greatest margin expansion. This is where the value lies.
That's it. Margin expansion is like, anytime I hear that, I hear money. I also hear money when I think about optics. The optics super cycle, I have subscribers in the two of these names here, and they are just maybe a little volatile, but they are absolutely on fire. The question for me is, it's a super cycle like, so how long does the super cycle generally last?
So if we think about AI infrastructure as an economy, the GPU or the AI chip is the factory, the network is, this is the roads. And with optics, we're still very, very early right. in this super cycle. The reason for that is that you want to use copper for as long as possible. When the traffic is relatively light and we're talking about local traffic, copper wins. Optics comes in when you need to build a motorway. So more lanes, faster speeds, longer distances. Importantly, we don't think it's either or. Okay. That's what we think the market's getting wrong right now. But because we're so early in the stage, this is what is propelling the top lines of the key beneficiaries here. But also, to your point earlier, we're seeing phenomenal margin expansion.
Yeah, it's I guess when the CEO of Broadcom suggested maybe copper over CPO, that kind of confused things. But the way you laid it out, copper now, but eventually it's got to be optics, right, for this thing to live up to the hype, and it will. I want to ask about AI eating software, you say if that's true, then these are the names you have to be long. This is it right here. Let me I don't want to go through all the names. I just want to go to the A Labs at the end, because A Labs has struggled a little bit lately, Astera Labs.
Yeah, sure. So Astera Labs, we view this company as almost the purest play on AWS's Trainium build-out, their custom silicon, possibly even more so than Amazon, because half of Amazon is obviously in the e-commerce business. But Astera Labs provides the connectivity layer as AWS is scaling its custom silicon infrastructure. And networking really takes over from the accelerator as the key bottleneck as clusters in the data center expand to 1 million GPUs. And this is why Astera Labs is growing 9 times the rate of legacy networking. So if you use Cisco as a proxy there, they're built on and for this new era of AI networking.
All right, love that. And we had NVIDIA, Taiwan Semi up there. And I think by now everyone should know those storylines by now. Software names. Not all software is going to be, killed, right? I mean, there will be some survivors. We've seen some great news out of Shopify here recently. We've seen great news out of AppLovin for a long time, but last year I think there were 3 short attacks on it. Today there's a negative headline. It's under some pressure. By the way, I have subscribers in that as well. What is it with AppLovin, though, that makes it so amazing and yet such a target?
Sure. So, I mean, to be clear, the reason the entire AI technology stack is so valuable is because of that application layer at the top. This is, however, where the disruption is occurring. And we would categorize software companies into 2 camps. First, software 1.0, built on and for traditional compute. And possibly 90% of today's publicly listed companies fall into that category. We wouldn't be touching these names. Companies, however, built on and for accelerated compute, software 2.0 winners, we're calling these companies have sold off indiscriminately alongside software 1.0 companies. So these are the types of companies we've been adding to on weakness. AppLovin is a very good example of this. They're essentially doing for mobile gaming what Meta's done for e-commerce, but crucially, it's underpinned by an AI agent. And this is why the company is so extraordinarily efficient. It's got revenue per employee of about 6 million right now, which is one of the highest in our investment universe.
All right, great stuff, Claire. Good stuff. I hope you come by more often.